All right, hello, welcome traders. Today I'm going to take a little bit of time just to talk about hedging. It's the one thing everybody loves to talk about. Everybody's always got questions on. It's not just cut and dry for everybody, and every account's different. So one size doesn't fit all. Hedges vary based upon your portfolio, your risk tolerance, and the type of strategies that you put on. All depends what you're doing. So my hedges may not work for you. They may not be set up, but I want to give you a sense of the hedges I'm doing based upon the types of trades that I do to give you a sense of hopefully what may work for you and you can get an idea of what you may want to put on. So first off, I'm going to start with the volatility hedges. We know that back in August of 2024, we had a pretty big vol spike event on the Japan carry trade. Okay, that led to some stop outs for people, and certainly led to some pain trading futures and having naked puts in futures. Because if you didn't have some sort of a volatility hedge on, your BP expanded significantly, where you may have been forced to close some trades, which also got to at least their 2x loss or over, and it was a really wide market. So what you want to do is give yourself the time to be able to get out of there um, without too much damage, or at least being able to offset that and offset your BP a bit. So there's a couple things that we can do, and I think they all work together in creating a portfolio. But one of the things that's key here is quantity kills. Okay. If you have way too many of one thing there, even if each trade has a 2x stop, but you have 10 of them or 20 of them or 30 of them going, okay, 30 at 2x stops, that's 60%. Right? So you want to make sure that quantity wise, if you're going to ladder trades and campaign trades, you got to keep that in mind. Now, it doesn't mean you shouldn't do the 112 trade at 120 days. That's fine. But if you do that, understand that you're going to be on laddering trades on for 120 days. They take at least 90 days for the naked puts to hit maybe 90%, which means you're going to have six of the eight tranches that you would normally have on times however many contracts each. I moved to a 112C, which is the calendarized version, and I'm putting on the naked puts around 60 days, and I'm still putting on the put debit spreads around 150 days, which means I've got a lot of extra put debit spreads hanging around, and my naked puts are coming off in 40, 45 days on average. So I'm not sitting there laddering on fixed tranches of four or six naked puts. I've only got maybe two or three tranches of four naked puts at a time. So my risk is cut in half that way. Plus, I've got all of these put debit spreads, which are giving us a bit of a hedge, okay, against our buying power, but they're also giving us a delta hedge as well. Now, is a put debit spread a great hedge? No, because you've got to have decay that comes out. Otherwise, they're only going to give you a modest amount of income, at least until closer to expiration. That being said, in conjunction with other things that we're doing, I think that can certainly help you out. So if you have this wall of put debit spreads that are 100 wide, I think it's going to help you. All right, let's get into the hedges a bit. So now you know the structure of the trade, and one of the things you can do is just reduce your naked put volume, which makes life a little bit easier if you're using ES and you have span margin. It's very subject to vol spikes. So let's get into our trade plan and let's look at the vol hedge that we've been using. And pretty simple vol hedge. I'm going to go through it in the Analyze tab. So I want to show you how this thing starts to work out. But essentially, we start the trade by buying 20 longs around 120 days at around $5. And then we're selling 10 shorts around $10. Now, this initial trade, okay, 20 times 5, 10 times 10, the initial trade should be basically a break even. Okay, you're really not, maybe $100 here or there, but initially when you put this on, there's really no cost to this trade. The cost comes that as the trade's moving, we're going to buy back these 10 shorts, okay, at 50% of the 50% profit. So if they were a $10 credit, we're going to buy these back for $5 debit. Now we're actually paying money. Okay. Well, how do we, keep this thing going because we're paying money? Well, we're going to buy 10 new longs for 5, and we're going to sell 10 new shorts for 10. Okay. So essentially, you're paying 5 to close at 50%, paying 5 to add 10 new longs, and you're going to take in $10 for 10 shorts. Again, you're going to then keep this as a kind of a neutral dollar trade. So you make a little bit of money when you close at 50%, but then when you put the new ones on, you're spending that same amount of money back in there. So hopefully it should keep you somewhere near a neutral, give or take a couple $100 here and there. And as you go through, you start with 10 shorts and 20 longs on day one. Then once those shorts hit 50% and you close those out, and then you put 10 more longs and 10 new shorts on. Okay. You've now, after one tranche, you're going to be sitting at 10 shorts still because we closed the first 10, opened up a second 10, but we added 10 more longs to our 20. So now we're sitting at 30 longs. Okay. Then once in another 45 days or so, we're going to do it again. We're going to take those shorts off, put 10 new shorts on, but we're going to add 10 more longs. So now we're up to 40 longs. So as this starts to go, eventually, once these initial 20 longs drop off, you should be perpetually sitting somewhere around 10 shorts at all times, 30 longs at all times, or more, depending on how many of these tranches you want to put on. Okay, hopefully this makes sense. If not, go back and reread the plan for this. But as I close the shorts, okay, I'm closing those. I'll be realizing some gains there, but I'm going to be then selling new shorts and buying new longs, and I will be taking in some money there to offset what it cost me to close. So I'm always going to be kind of dollar neutral, but there'll be times where I've seen realized gains in closing the original shorts. And until either we close the longs or we close or roll the next shorts, there's no more realized gains. So you have a little bit of an up and down on the realized gains, but eventually it does really come out to a net of 0. But let's take a look at how these things work. So I'm going to share my account, and we're going to go through the Analyze tab in Tasty. So what I've done here is all of my positions are in here, but I've only checked off and highlighted everything that's part of this vol hedge. All right, so I've got 20 longs, which are going to come off. So my initial 20 longs, they're going to come off in 7 days. They're almost worth nothing, but they're going to come off in 7 days. I've got these other 20, I have 2 tranches going. So I've got these other 20 longs. These are going to come off, but we got 24 days. They're giving us a little bit of a bump right now. And you can see right now we're looking at, okay, 4% down, 8, 12, 16, 20% down move in the market. And I'm only right now looking at like a 20% bump in IV, very small IV, because I want to show you how this really works longer term. All right. Then here's another 10 longs from a roll. Here's another 30 longs from a roll. Here's another 10 longs from a roll with 10 shorts. Okay. And then there's also another 30 longs and another 30 shorts that'll come off. So once these 30 shorts and these 10 shorts, once they get to 50%, I'll be closing those and I'll be adding another 10 long, selling another 10 short, and then the 30s, I'll be adding another 30 long and adding 30 shorts to pay for it. Okay? So you can see that these shorts, obviously, there's going to be a nice loss on those, 137,000 if we drop 20% in the market. However, it's going to be offset by all of these longs. Okay, the shorts are taking a beating. Okay, 59,000 plus 137, so that's a pretty good beating. But you've got all these other longs, even at low deltas. Okay, these longs are doing okay, even at 20% down. Now, what you don't really want is a slow grind down move, But you can see that even with a slight bump in IV, maybe a 20% bump, which is really tiny, okay, these things still pay off. Okay, they're still paying off as we drop. Okay? But the magic really starts to happen when IV starts to spike, and that's the whole reason for the vol hedge. So let's say we spike up 30%. Well, now you can see we've gone from about a $5,000 down 20%, or even at a small loss down 12% of 951, okay, to 33,000. So a 6x increase down here for a very small increase in IV. And IV can go up 40, 50%. At 50%, I'm generating over $112,000 now. If the market still goes down 20%, but IV spikes, and even if the market doesn't move much, maybe it only goes down 10%, but spikes 50% here, we're going to make $59,000 on these hedges, which should be a pretty good amount to offset a 2x loss if we get out at a 2x loss on our uh, on our naked puts. Okay. Our naked puts are typically being sold for somewhere in the neighborhood of, let's say, $3,000, $4,000 is my income for selling my four naked puts. I take in around 3,000, 4,000. Let's just use 4,000. At a 2x loss, that 4,000 becomes an $8,000 loss, which for me is only 2%, which is fine, 2% of my net lick. So everything works fine there. And if I'm able to get out at a 2x loss, even if I lost on two or all three of the puts that I might have on at any given time, that might be a $24,000 loss. And no matter what happens to the market, I can offset that loss. And we also know that back in uh, the August, we went up more than 50%. So if we see 100% spike, okay, here, we start to see some pretty substantial numbers, anywhere from about 200 and some thousand up to $418,000 from just these hedges alone. So that's how the volatility hedge works. That if you see a giant spike, even if you don't get a big move in delta, and we only go down 8 to 10%, you're still going to see a substantial increase in your returns, even with the market not moving. Okay, but you see a big spike in IV, and even at a 50% or a 60% spike in IV, okay, it's a pretty substantial amount of money that should overcome and offset most of the losses that we would see in any of the naked puts. And that's all I'm looking for is I want the BP relief that all of these puts are going to give me. So it's going to keep my BP under control, and it's going to help offset some of the losses. It may even make some money. That's not my goal to make the money, but it's going to offset losses or mitigate the damage that may be done if I couldn't get out at a 2x loss, or even if I do get out at a 2x loss on all of my contracts, I'm still going to be in good shape. All right, so there's the vol hedge piece. Let's get into one other hedge that I'm doing here, and this is the ratio hedge, which is going to focus on a kind of a similar setup. So let me go and talk about the ratio hedge that I'm using here. Now, the nice thing about the ratio hedge is they really don't have much risk to the downside due to the spread of the ratio and the fact that I have more longs than shorts, just like the vol hedge that I have. Now, the ratio hedge it's really going to give me a really good black swan hedge that if the markets really tank, these are going to pay off great. It's going to give me a bit of a vol hedge as well. And it's also going to give me a bit of a delta hedge as well if we move down. So it does a little bit of everything. So together, there's a very, very similar trades. And I'm not sure that I'm going to stick with both, but both of them have a place in my portfolio, and they really don't cost me a ton. Now, the ratio hedge is going to have a cost to it. So let's get into this trade. So the buying power and sizing on these, okay, I'm looking to turn these ratio hedges into roughly a 30-day long hedge. okay, which is can work as a delta, a black swan, and even a bit of a vol hedge. Okay, so when these things start to mature, they become just a long put hedge at around 30 days left in the trade. Okay? And the goal is to create a bunch of contracts and a wall of these ratio hedges that are going to help me out. Now, what's the cost of this trade? Well, we'll get into it, but it's about $75 per three short contracts that I have. I'm going to be doing these 20 longs and 12 shorts. So it's still a 5-3 ratio. So it's going to cost me roughly 75 times three or so is about what it's going to cost me. So 12 times 5 times 50, about 300 bucks, give or take. So going to cost me 225 to maybe 300 for what I'm doing per every 2 weeks, which is going to be about 600 bucks a month. So for $600 a month, I'm giving myself a pretty good black swan hedge and an additional vol hedge. I feel really, really good about the way this is set up. How do we do this trade? Well, we sell 3 shorts at $5 and buy 5 longs at $3. Okay? 3 times 5 is 15. 5 times 3 is 15. There's no cost to put this on. I'm doing these at about 120 to 150 DTE. I think it's probably better to go a little bit longer, like the 150s. I've been doing the 120s, but I think the 150 is a little bit better because you have a little bit more protection for longer. Right? You'd love to put these on a day when the market runs up heavily. And ideally, if you could put it on for a very small credit of 25 to 50 cents, that would offset a lot of the closing costs on these too. So if you put it on for a very small credit, not a big credit, a very small credit, it can offset some of the cost of closing down the short puts, right? And then I will typically do these about every 2 weeks, and I ladder these on. As I put on my 112C trades, I put on this ratio hedge. And then simply here, all I do is I take the shorts off when they hit 90% winner. Right? So if I sold them for 5, I'm going to be taking them off for about 50 cents. Okay. Now, you can take them off earlier if you really need the hedge due to something happening in the market. You start to see us going down, then maybe I will pay more to take them off just to give myself some hedges if need be. Otherwise, my goal is taking them off at 90%, which is about 50 cents each, and I'm doing a 12 short, 20 longs. The 12 shorts means 12 times 50 times the 50 multiplier is about 300 bucks every 2 weeks on this trade. Now, if I'm taking in a little bit more credit, even if I'm taking in 25-cent credit, that's going to cut my cost in half. So I'm paying 50 cents to take them off, but I took in 25 cents at the beginning, then that's going to reduce my overall cost on the trade. Let's look in and see how these things will work as we move through it. And I'm going to redo everything that we've got in here. So we're going to take these hedges off. So I'm going to take off all of my hedges, okay, for all of my trades. So I have no trades on now. And I'm going to put these trades on. All right, so here's my 20 and 12. Now I don't have any longs yet. 20 and 12, 20 and 12, 20 and 12, 20 and 12, and then this 20 and 12 from today. All right, so this is how these things are going to look right now. So how does this trade perform? Let's go back to that 20% or so move. It's a ratio hedge. So when you're doing a ratio hedge, you do have that valley of death all the way down at the strikes, but you're looking at strikes that are down around 2,400, 2,900, 3,000. Okay. That is well below 20%, and you have to be in the valley of death within the last week of expiration for it to really do anything to you. So I'm not too worried about that. We're going to manage these well ahead of time. Okay. But let's say right now the market goes down 8% and there's very little shift in IV. Okay. We're going to make about 4,000. If we go down 12, 16%, we're basically breaking even here. And if we're down a little bit more, like 16 to 20%, we have a little bit of a loss on these because we're getting closer to that valley of death. However, that's with IV doing nothing. So if we drift lower and we go down a couple thousand points in the market with no spike in IV, which would be an extraordinary rare occurrence for us to actually drop thousands of points without volatility increasing, would be incredibly rare. But if they do, this is the worst that's going to happen to me. Okay. And you can see that, most of the spreads here, the worst is about $1,000 of spread losses. Okay. But let's see what happens as volatility starts to pick up. So if volatility goes up maybe 50% overall, now these start to pay off. Even if I don't close the longs, because I have more longs than shorts, you can see now the longs in green, okay, are starting to outpace the shorts in red, no matter how many contracts you have. So you're actually going to be making money even if the market does nothing, but the vol spikes, you make 40 some grand. Okay. If you drop 20%, we make 58,000. So either way, with a little bit of with a vol spike in here and a loss, we start to make some money. Now let's go back to looking at what happens when I start to close some of the shorts. And I'm going to take this back down to, let's just say 25%, which is kind of a break even down here. Okay. But let's say I take off the shorts, okay? And now I'm left with 20 longs, and I'm only going to do it on the nearest term one. So let's say this one comes off at a winner, okay? Well, now you can see we're starting to actually spend money. As we drop down, it's giving us a delta hedge, okay? It's paying off as the market falls. The farther the market falls, the more this trade now starts to benefit and starts to generate cash. If we get any kind of a vol spike down there, okay, now we're looking at even greater returns the farther we fall based upon IV rising. Okay, but I'm going to keep it down here with just a slow sell-off. Okay, so this is really what it's going to look like for me. Is this a lot of cash? Okay, right now, $16,000 to $18,000, not a giant amount, but that's if we just get a slow sell-off. And all I do is when we get to around that 45 days or 30 days, if we're just closing the shorts for that $300, you're getting around $20,000 in protection, or anywhere from really $12,000 to $20,000 in protection with no spike. If you get even a 50% increase in IV, which is not massive, okay, you're getting almost $100,000 of protection, somewhere between $55,000 and $100,000 of protection for roughly $600 a month. And if you get a massive IV spike, okay, up to that 100% again, okay, now you're looking at $250,000 to $300,000 worth of gains on these because the longs are outnumbering the shorts. You've got IV spiking, which is making those longs gain more value quicker. And with a big IV spike, this thing really pay off. So when we look at all of our pieces together here on a pretty good spike of 100,000, we're going to generate a lot of cash. So let's go on and put on everything that we have, including all of our put debit spreads and all of our naked puts. We're going to put all of our trades back on. So let's get all the trades back on. Okay, I think we're about there. And then last. Okay, so we've got all the naked puts and everything back on. Okay, so you can see what's going to happen with all of the naked puts that we have on. And we have multiple naked puts on. We also have a 120-day naked put on. We have even some spec trades with naked puts. If IV jumps 50%, okay, even on a small down move of 10%, we actually make money. So we're making money 10, 15% down. We're actually making some money on a small bump in IV. And then if the market would actually drop a full 20% with only a 50% spike in IV, we're still going to lose money, but we're only losing like $66,000 here, okay, on this, mainly because that's letting these uh, naked puts go well past their 2x stop. Okay, here's one of them. Let's actually pull up this one. So this 46.50 right here, this trade, you can see this is $63,000 loss. Now remember, a 2x stop was the $8,000 loss, not 63,000. But I'm playing along here that we're going to blow through my 2x's, and there's nothing I can do about it. Okay, and we're going to go to somewhere in the neighborhood of a what 6x, a 6x to spike all the way down here to a 10, 11x loss. Okay, on that particular one. And so just because, and then here's another one here at 5,100. Okay, it could lose $100,000. Now, again, this was a trade that was just put on today, so it's fresh. There's been no decay. Okay, we could lose $100,000 if the market drops 20% and spikes 50% in volatility overnight tonight, and I miss all of my stops. But that's going down $100,000 at a 25x loss. Even in the worst of August 5th, the worst I was getting out was like a 4x or a 5x loss because of the width of the wide spreads in the middle of the heat of the battle. Okay? Never at 25x. But if that would happen, we'd have a bit of a loss. But that also spiked over 100%. So if that does happen and we spike 100%, we actually start to make, even though these losses on both of these will be substantial. Okay, we're going to make 378,000. If we drop 20%, we're going to make 335 here. So we're betting on a vol spike, accompanying a massive drop and us not being able to close out our trades. So I feel pretty good here that even at 100% vol spike like we had before, that we're going to do fine. And even at a 50% or 60% vol spike, we're still going to make money and not lose. And I'm pretty confident that I will actually be able to stop out at better than a 25x stop. Even in August 5th, we had a chance to stop out at a 2x loss on that Friday, and we were able to actually get out at a 3x, 2x, 3x on that Sunday. It just got wider and crazier that some people stopped out at a 5x loss or something like that on these. And if you had too many trades, 5x losses times 6 tranches, pretty substantial cash. So 5x loss on a $4,000 trade is 20,000 a piece times 6 tranches. It's a $120,000 loss. Okay. However, if that happens again, we're well prepared for it. So I hope this helps you with the difference between a perpetual vol hedge and the ratio spread hedge, which is more of a black swan hedge, but also will help us with vol hedging and delta hedging as well. So it's a little bit of a mix of everything. What I didn't get into was how do the put debit spreads play into this. So let's take one more look and let's go through how do the put debit spreads play into all of this. Well, the whole thing here is paying off, but I'm going to pull off everything that's not a put debit spread. Okay, let's see if we can make sure. Oh, there's a bunch of these too. So let's go here. 2 and 2, so 51.25. Some of these have been rolled as well. So see if we can get all of these things set up correctly. 54.50. This may take a minute or so as I go through. So let's start taking things off. Okay, and we're just going to put on the put debit spread. So April 17th, we have 3 contracts, which would be these two. There's one put debit spread. Then April 30th, we have another put debit spread. Okay. Then on May 16th, we have a 2, and that is the 54.50, 53. 50 debit spread on May 16th. Okay, then on May 30th, we have this put debit spread. Then on uh, June 20th, we have this put debit spread. On June 30th, we have two different tranches of put debit spreads. On July 18th, we have none. On July 31st, we have two, okay, which is what we have. And then August 15th, we actually just put on, we have two sets. We put on one set today and we already had one set on. This is how the put debit spreads of the 112Cs are holding up. And let's go back to that. Let's just go back to that 20% increase. Here's how the put debit spreads are also paying off. The put debit spread alone are generating anywhere from about $10,000 to $60,000 with almost no spike in IV. They're really a delta hedge because they're a full put debit spread, and the closer they are to expiration, the better they perform. Okay. So you can see the on average 7,000, 7,000. This one's worth about 8,000. This one's worth 7,000. This one's worth 7,000, 6,000, 6,000, and then 6,000, 3,000, and then only about 5,000 here. So again, these spreads, I think the closer to expiration they are, the theta decay is going to give you a better chance of hitting the 100 wide. And some of these are only 50 wide, not even 100 anymore, because I've already rolled up the short puts to book some of the profits as the market went down. So this is what's left after I've already closed or rolled a couple of these. These two have been rolled already once for profit. Okay? They're providing me with almost no increase in IV, even if at 10%. Okay, these things, okay, with no IV movement at all, will pay off if the market starts to sell off anywhere from 8 to 12 to 16 to 20% down. These things really start to pay off. And again, as a group, this is a wall of put debit spreads. They would technically cover more than a 2x loss, okay, if the markets start to move down. Now, if volatility does spike, these things really start to pay off at 50%. They're paying off anywhere from about 10 to 50,000. And at the massive spike, even right now, these things would still pay off 10 to 50,000. Okay. Again, there's a maximum amount that you're going to get out of these. Okay. So it doesn't matter how big volatility spikes, they only go up so much. Okay. Because they're a spread. Anyway, these also are factoring into that whole scenario that we put together. All right. I hope this makes sense for you. A little bit of hedging 101 from me and how I'm looking to do it. Maybe it's a little bit overkill, but they really don't cost me much. The only one that costs me something is the ratio spread, and it's really $600 a month, okay, or less. If I'm taking in a credit, I'll totally take that to protect my entire account in case of any kind of a vol spike or a black swan event. All right, take care. We'll see you guys later. Bye-bye.